Prakash, I'll come to you in just a bit, but we have Nimesh joining in to talk about the diagnostic companies as well and why they're in focus. Nimesh.
Hi, Sonia. So there is an interesting report from Antique today on the diagnostic sector, and they've initiated a sell on Dr. Lal Pathlabs and on Metropolis. On Dr. Lal, they have a target price of 1643, which indicates a potential 33% discount from current market price. And on Metropolis, they have a target price of 1232, a 12-13% discount from current levels. Now, the key reason why they've initiated a sell report, one, they believe that with competition increasing and the COVID-led tailwinds now behind, the industry is going to face a scenario of lower CAGR. In fact, they believe that the margins that some of these companies reported in FY21 will not be repeated anytime soon. So it will go back to the long-term averages of 10 to 12% versus 15% plus that was seen in the last few years. Even on return on capital employed, Antique believes that these will be under check and will fall down to 25-26% versus the pre-pandemic scenario of 33% plus that these companies reported for the last few years. So the valuation, there's going to be a valuation derating for the entire sector, and hence a sell report on both Dr. Lal Pathlabs and on Metropolis from Antique with big downside targets. So that's something which stood out for me from the Antique note. Okay,
Nimesh, you also have a standout brokerage report, I guess.
That's right, Anuj. So the today's standout is on ABB. This stock has been on a tear, has been a big move, and Credit Suisse has now today downgraded the stock to underperform from neutral, and they have retained the target price of 2600. Again, a big downside from where the current stock price is. Now, the key reason for the downgrade is one, of course, the stock has rallied pretty hard, or 76% in the last 1 year, and even in the last 3 to 6 months, the stock has rallied between 40 to 50%. So that's been a big contention, that the stock has rallied pretty hard. Now, while Credit Suisse believes that there is they see evidence of investment cycle picking up, but after the sharp run up, the stock is now trading at over 70 times FY23 price to earnings, which implies a much higher expectation from the street. Even on a DCF model, they see just a 20% CAGR, which is versus the all-time high margins of 20%. So on back of big move in the last 1 year, and the valuation is quite expensive, they've downgraded the stock now to underperform. Within that investment cycle space, they still have an overweight on L&T, and they prefer Siemens over ABB purely from a valuation point of view. But the downgrade is largely on the back of a big run-up in ABB, and hence a downgrade to underperform now from neutral.
Okay, Nimesh, thanks a lot.